the latest inflation data may be months behind, consumers are still feeling the pressure in real time. And even though parts of the market appear to be slowing, there are also pockets of strength that continue to shine. A reminder that this market is far more dynamic than the headlines suggest. We are still waiting for new inflation data, but everyday spending is giving us a clear picture. Prices are still elevated, and households are navigating in real time. Yet, despite that, the equity market hasn't rolled over, and it has simply rotated. Large cap communication services and tech have surged more than 20% year to date, showing that leadership remains strong, especially among companies with resilient cash flows and forward-looking growth stories. So even when the broader market pauses, leadership pockets continue to carry momentum. That is historically a positive sign rather than a warning. December is almost always active. Historically, the S&P 500 moves roughly 1% during the month, not because the fundamentals shift dramatically, but because investors reposition. Profit-taking, tax loss harvesting, and end-of-year rebalancing all create natural flows. These are not signs of trouble. They're signs of a healthy, functioning market preparing for a new cycle. Meanwhile, silver has joined gold and platinum in a sharp upward move, with prices approaching historic levels. This surge isn't driven by industrial demand. It is driven by global central banks. Around the world, reserve managers have been increasing their gold holdings as they diversify away from concentrated currency exposure. The Bank of England, the Bank of Japan, the European Central Bank, and even the Bank of Canada have all made adjustments to their reserve compositions over the past year, reinforcing gold's strategic role. It's worth noting here that historically, precious metals were not reliable hedges against inflation, but today's rise is more about reserve strategy, currency diversification, and global demand, not fear. That is a constructive backdrop, not a reactive one. We still haven't seen new inflation figures since the September uptick to around 3%, which leaves the Fed in a tricky position for its December meeting, where markets already priced in another cut. But here's where things get interesting. Chair Powell's term ends in April, leaving only 2 meetings before the next chair takes over. If the incoming leadership prioritizes economic growth, which appears increasingly likely, we may see a more proactive rate-cutting cycle, a tailwind for risk assets than a headwind. Combine that with strong sector performance and continued demand for stable stores of value, and the picture looking ahead becomes more optimistic for equity than many assume. So yes, consumers are feeling the pressure and the data is lagging. But beneath that, we are seeing stability in leadership assets, strength in key sectors, supportive central bank behavior, and the possibility of a more growth-friendly Fed. This isn't a market running out of momentum, it's a market adjusting, rotating, and setting up for what comes next. I'm Tammy Beck, see you in the next video.